Hey, it's Pat Jennings again from thebizseller.com, and this is the fourth video in my five-part series on small business valuation. And I wanted to use this video to clear up one of the biggest points of confusion and misunderstanding among sellers. And it's a question I get all the time, and basically the question is, how do the items on my balance sheet, inventory, equipment, cash, accounts receivable, things like that, how do the items on the balance sheet affect the valuation if you're using a multiple of earnings? Now, if you've seen the previous videos I've done, you know that I suggest for smaller owner-managed businesses that you use a multiple of earnings as the way of valuing and setting your asking price for your business. And specifically for earnings, I suggest you use the calculation of owner's benefit. And that would be the pre-tax profit plus the owner's salary, plus the owner's perks and benefits, plus interest and depreciation as your figure for earnings. And the question, though, becomes, well, what about all of the other things that I have that are of value, like my machinery, my equipment, my vehicles, my inventory, my experienced salespeople and other employees that do a great job. They're all of value. These days, a lot of businesses have a website and a domain name that is very well known amongst their customers, and so the customers come to the website to reorder products or make reservations, and all of those things are very valuable. So if you're using a multiple of earnings to set your asking price, how do all of these things on the balance sheet come into play? And so that's what I want to talk about. And really it depends on what items on the balance sheet we're talking about. First and foremost, and most simply, cash and accounts receivable. When you sell your business, you're going to take those with you. Definitely you'll take the cash. There's no reason to leave. Let the new owner provide their own working capital. The accounts receivables, that represents sales you've already made, products you've already delivered, services you've already rendered. You should collect that money. Number one, because the buyer is not going to pay you the full face value of those accounts receivables. They're going to look at your accounts receivables and they're going to want to pay you next to nothing for your 60-day-old accounts and absolutely nothing for your 90-day-old accounts. So you're not going to be able to get the full face value for them. So take the cash and take the accounts receivables. Now, the next thing is, what about all of those things that are of value, like your vehicles, your equipment, your machinery, your workforce, your domain name? Well, if you're using a multiple of earnings, you've already accounted for that because you need all of those things to generate the earnings that you're using in your calculation. So you can't take, let's say that you have earnings of $100,000 and you're going to multiply it by 3 to come up with an asking price of $300,000. Well, to generate that $100,000 in earnings every year, you need your employees, you need your domain name, you need your equipment and your machinery and your vehicles, and the new owner is too. In fact, that's ultimately what they're paying for, are the things that generate the earnings. So you can't double dip on that. If you could do a asset-based valuation, but you only want to do that where you just assign a value to each asset that you have and you total it up. You only want to do that asset-based valuation if you're losing money, so you don't have earnings, or you're a really new business and so you don't really have much of a track record of earnings. But when you do that, that's going to give you your lowest valuation. So if you're doing a multiple of earnings, those earnings, it's implied, those earnings have been generated as a result of all of those other assets. And if the owner, the new owner, the person buying the business from you, doesn't have that machinery or that experienced workforce or that website, then they can't generate the earnings. So the value of those assets are built into the multiple of earnings calculation. So you don't want to add on top of those, except for inventory. If you're in a retail business or a distributorship, and every 30 to 60 days you're turning over your inventory, well, you have to price that separately, because that's not a permanent asset. the owner's always going to have to go out and replenish the inventory. So particularly when you're advertising your price, if you have a retail business, you have a distributorship where inventory is a big expense and it's a recurring expense, you want to let the buyer know that you're asking $100,000 for the business plus inventory. Now, as far as, valuing your business today, you might want to estimate what your inventory is so that you have some idea, but the actual inventory should be taken as close to the closing as possible, and you want to value that inventory at its replacement cost. What will it cost the buyer to go out and replace that inventory? And yes, you do want to tack that inventory number onto the selling price, but that's the only time that you would add something to the multiple of earnings. Like I said, take the cash and accounts receivable with you when you sell it, add a number on for inventory at the closing, that's, because that will be the actual inventory that they're going to inherit, and realize that the other assets, your website and your vehicles and your experienced sales force, all of those things went into generating the earnings that you used in your multiple of earnings calculation, so you're not going to add them on top of that. Now, if you'd like to get some more tips, advice, information on selling your business, and you haven't already signed up for my newsletter, please go to thebizseller.com. You'll see a sign-up box there for your first name and email address, and sign up for my Sell Your Business Tips newsletter, and we'll send the current issue out to you right away. And then every week thereafter, you'll get new information, new tips, new hints, advice that you can use right away to help sell your business as soon as possible and for as much money as possible. So again, that's thebizseller.com, first name and email address, and the current issue will be on its way to you. Thanks, and I'll see you in part 5 of my Small Business Valuation series.